Warren William here from Smartest Data with Quick Definitions, helping you understand how to analyse stocks, the stock markets, the language and terms, and all the ins and outs. What is a liquidity ratio, and how is a liquidity ratio used to understand the repayment of a company's short-term debts? Let's go to the video, define and explain liquidity ratios, and at the end of the video there'll be 3 quick bullet points to take away. A liquidity ratio is a financial ratio that measures a company's ability to pay short-term debts. A company's liquidity ratio is calculated by dividing a company's liquid assets by its short-term liabilities. Liquid assets are cash, cash equivalents, marketable securities, and accounts receivable, while short-term liabilities are debts that are due within 1 year, such as accounts payable, taxes payable, and short-term loans. A high liquidity ratio indicates that a company has a strong ability to pay its short-term debts. There are several liquidity ratios, including the current ratio, the quick ratio, and the cash ratio. In closing, 3 quick bullet points regarding the liquidity ratios. Indicates the ability to pay short-term debts. There are a number of ratios that are used. A high ratio indicates a sound level of coverage.